Okay, in this video we're going to talk about building a portfolio of trades, and that's really what we want to do. We want to be able to build a portfolio of trades because, if you do a single trade, yes, you can make some money and you can adjust it and so forth, but what we really want to do is we want to build a portfolio so that it spreads our risk a little bit over the course of a number of different indexes. And most of the trades that we're going to be putting on are, in fact, in the indexes. We don't normally put on these types of trades on individual stocks because there's a couple different risks involved in individual stocks. Number one is early assignment. If the option that you sold goes into the money, you could have there could be a risk there of early assignment. Generally on the indexes, you may not get that. You might get it, but you may not get it. And a lot of these indexes are also cash settled, so it's much easier on you, and you don't have to worry about being assigned early on a stock. What we want to do is take a look at building a portfolio. The picture that you have in front of you is our demo account that we're using for all the videos, and it shows you that, in fact, we have 4 positions on. If you take a look down at the bottom here of the screen, we have a diamonds position, we have an EEM, we have an IWM, and a SPY position. The diamonds are the ETF equivalent tracking the Dow Jones Industrial Average. The EEM is the emerging market ETF. The IWM is the Russell 2000 ETF, and the SPY is the S&P 500 ETF. And we build our portfolio generally between 30 and 40 days before expiration. Right now, we're about 23 days to expiration. So we've had these trades on now for just a few days, about a week or so. And like I said, in the beginning, your position is not going to show a profit because what happens normally to an option before it gets to expiration? Well, the closer it gets to expiration, the less valuable it becomes, so it declines in price, and that's exactly what we want to see. We want to see a decay of the options that we've sold because that's how we've collected the premium, and we want to be able to collect it. We want to keep that premium. And the only way we can is if, in fact, those options decline in value. The closer we get to expiration, there's less probability that those will ever become valuable, so that's how we collect our money. Now, this is an aggregate portfolio position that we have in our demo account. Right now, the white line that you can see here that I'm running my cursor along is our current profit and loss position. We have a small loss on the position overall, but that's only because we just entered into the position. The green line is our maximum profit potential, which we will experience on option expiration. In our case, we're selling the May options, which has about a little bit more than 3 weeks to go before expiration. The majority of your profits are going to come between now, about 3 weeks to expiration, and about 7 days to expiration. So there's like a 2-week period in which this white line will gradually rise up into this position up here, giving us a 50, 60, 70% profit potential on this position of our maximum potential profit. And that's where we want to start taking positions off. We normally do not hold these positions all the way to expiration, only because in the last few days of expiration there's more price risk with our position, but it depends. I mean, in the other videos on closing out positions, you can see exactly why we did close out positions and when we did them. Let's talk about building your portfolio. We already have our portfolio on here, but I want to show you exactly how we entered into each one of these positions and why it's important to do a portfolio rather than individual trades. I'm going to take a look at IWM here, but there are 4 main, they're highly liquid ETFs with highly liquid options. And those are the 4 that I mentioned before. So let's take a look at how we actually enter into these trades. There's 2 types of trades that we want to do. We want to do what's called a double calendar, and we also want to do something called a iron condor. Those are the two main trades that we really use on a monthly basis to generate the income that we get in this program. What we want to do is go to the Trade tab, type in IWM. You can see that the description is that they are Russell 2000. It's the Russell 2000 ETF. You can take a look at the options. Now, if you do not have, right over here on the right side, when you open up this window, if you see a window like this and it only has 4 strike prices in it, then you want to open this up and type in 30 here so that you can see a great many more strike prices than you would normally. So you want to really open this up and see as many strike prices as possible. I also want to just mention that yes, even though you do make most of your money within the 2 or 3 weeks before expiration, you still want to get your positions on 30 to 40 days before expiration, because it gives you an opportunity to adjust those trades if necessary before you get into that period of really where the majority of your profits are going to be made. It's very important, and I mentioned this in other videos as you go through it, that the majority of option traders will simply put a position on, and if it isn't working out for them, they close out the position. And that's why they normally have losses in their trading, because they don't know how to adjust. And adjustments are absolutely critical to your profitability. And we have an entire video series just on adjustments that are absolutely critical, because anybody can put on a position, but it really takes the management of your portfolio in order to realize the full potential of all your trades. And the only way you can do that is through adjustments, if necessary. Sometimes adjustments are not necessary. But what we want to do here is take a look at how we actually put these positions on. You can see that we currently have a position in the IWM. We have the 67 strike, we have the 70 strike on the put side, we have the 70 strike and the 74 strike on the call side. We have these existing positions. Now the positions that we have in the IWM, let me just show you what those look like. This is a double calendar. And right now it looks like this. Since the market is moving up, you can see that we're not quite in the center of our tent here, but the market is moving up, so we're not too worried about it right now. This position actually is a little bit more complicated than the normal position because we had to do an adjustment on this. Let me pick out our EEM position. It might be a little bit easier for you to kind of see how this was constructed. We currently have a double calendar. Now, a double calendar is the sale of a put and a call in the front month option, and the purchase of a put and a call in the next month out option. It could be the next month, it could be actually 2 or 3 months out. The reason we do that is we're selling the short-term option, the front month option, in order to collect the premium because it will expire before the next month. So if we sell that month option and those expire, we'll be able to collect the entire premium on those while we still have value in the next month out. The difference between the sale of the front month option and the purchase of the next month option is the profit that we're going to be making on this position. And the way that we enter into these positions is in the TOS platform is really pretty easy. For example, if we wanted to do a double calendar at the 155 level, all we have to do is right click on that, buy, and guess what? They have a double diagonal double calendar already set up in their platform for you, so you don't even have to think about it. All you have to do is click on that and it brings up the log box for a double calendar. Now, a double calendar means buying and selling at the same strike price but just in different months. So in this case, we're selling the May 155 call, and we're buying the June 155 call. And the reason that we're doing that is because the May option will expire pretty soon, within the next 3 weeks. Well, the June option has a much longer expiration. If we go up here to our options trade tab for a second, you can see that the May options expire in 23 days. The June options don't expire for 58 days. And the difference between those two means that we can collect, because we're selling the May options, we can collect those premiums. And they expire, and remember, the closer they get to expiration, the less valuable they become. Well, this one has so much longer to go that it's not going to hurt our position. We're actually going to be able to collect these premiums, but we have the June options as protection. And then, of course, when we close out the position, we close out everything all at one time. So let's take a look at this position. Now, when I right-clicked on this and I brought up the double calendar order entry box, it automatically filled in the calls that I wanted, but it didn't fill in the puts that I wanted. I actually want to go down here to the 140 puts because we want them just slightly out of the money. And we want to be able to select both the same strike prices on the front month put and the back month put. So we want to do the May 140 put, and we want to do the June 140 put. Now, the way we can analyze this and see exactly what our position will look like at expiration is to right-click in this dialog box, anywhere in this green area, and go to Analyze Duplicate Trade. Now, since we already have a position on, we have to go to this box right here and just say Hide Positions. So we're hiding our existing positions, and we're just taking a look at what this double calendar would look like without our existing positions, just as a simulated trade. And as you can see, the strike prices that we selected down here doesn't look particularly attractive in the center. There's not much profit in the center of this double calendar. It's nice at the peaks, but the chances are that it's not going to, the price of this ETF is not going to settle exactly at these prices. We want a much larger range of price movement than we have here. So we have to raise the middle of this, what I call my profit tent here. And the way that we do that is just playing with the strike prices. The 155 call is probably the right place to do this. And I just clicked off this price thing because as soon as you start moving these strike prices around, you want to make sure that this is green here. You want to be able to capture the current prices of these options. If you had this locked down in a red, it would stay at 505 and it would skew your results. So we want to keep that open right now. Let's move the strike prices of the puts up a little bit and see what it does to our profit graph. That looks a little bit better, doesn't it? I mean, we've raised the center of this tent, so we have a little bit more profit in the middle. We can tell that we're in profit because if you take a look over to the left side of this graph, you have the zero line, which is zero profit here. Above that, you have your profit potential of the position. And below that, on this vertical axis, you have the potential loss on this position. And on the horizontal graph, you have the price of the actual ETF. So this does look a little bit better. I mean, we raised up the middle, so we've got a wider range of profit potential in this position from this peak all the way over to this peak, which represents about a 10-point move in this ETF. The problem is our current price level is a little bit below center. We like to try to keep it in the center, but I guess it depends on a number of different conditions. This could actually be a fairly good trade if you're very bullish on the market at this point, because we have a little bit wider room to move to the upside. So what we want to do at this point is take a look at this. Now, this would be a fairly good calendar maybe to put on if you were very bullish on the stock. However, do not like to predict price. We don't know the future. We don't know if prices are going up. We don't know if prices are going down. So normally we like to keep our price right in the center of our little tent and adjust later if necessary. So how can we move this tent over so that it's in the center of our price? Well, one thing we can do is kind of play around a little bit with our calls. Our calls we had set at 155, which was just above the market. The current market for this ETF is 146. So let's see if we can go to the 150 calls and see what that does to our tent. Well, it does. It puts us a little bit closer to the center, and that's probably as good as we're going to get. In order to have a nice wide tent on this position, we want to have the difference between the calls and the puts to be at least $2.50 to $5. Now let's see what happens if we put these positions on at the exact same strike prices. And I'm talking about selling the puts on the front month at the same strike prices we're selling the calls on the front month. Let's see what happens to our tent. All of a sudden, our tent begins to look fairly, not as wide at the top for sure. So we can take a look at the 145s and see if we can get closer to the center of this. And we're selling all of the 145s, but we're still a little bit off center, aren't we? And we don't have as much, we don't have a wide profit potential at the top of our graph. We're actually, remember this green line is what our profit potential is at the expiration of the front month option. So if we were to go all the way to expiration, that's exactly what this is exactly where our profit would be depending on the price. If the price was 141, our profit potential on this position for one contract is $175. If it settled right at 145, which is the center of our tent, which is the highest profit potential for this position, our maximum profit is $540. But this is not as attractive to me as our previous position. So let's take a look again at our 150 calls. We want to spread these out just a little bit. And now we've got a much wider profit potential, even though it may be a little bit lower, but I think it has a little bit more potential to be profitable because we have a wider range of price in here. So this is the profit picture that you really want to get. And the only way to get this profit picture is by playing with the option strike prices. Remember, we want to sell both a call and a put because we don't know which way the market is going to go. So we need to be, we need to keep our, since we're not predicting price, it doesn't matter if the market goes up, it doesn't matter if the market goes down. We want to be in the center of this profit potential position at all times. That's how we put on a double calendar. That's exactly what a double calendar is. It's the sale of a front month option. In this case, we're doing the Mays, and it's the purchase of the next month out, or possibly even 2 months out, of a call option at the exact same strike price. Now, to enter this order, all we have to do is right-click again in this green area and go up to Confirm and Send in order to enter this position. You can see that you have the order description up at the top. It's we're buying one contract, double diagonal, and it's actually a double calendar, but it's a double calendar is similar to a double diagonal. The only difference is the double calendar uses the front month and the back month strike prices are exactly the same. So we can enter this at a $5.79 limit. It does not give us our break-even, maximum profit, or maximum loss in this position because we're using 2 different months in order to put this position on. The cost of the trade for one contract is $579. There's $6 in commissions for a total cost of $585, which, by the way, is also the total maximum loss that you could have on this position. Since we use both puts and calls, though, the stock cannot be, in this case an ETF, can't be in the same It can't be up and down at the same time. It can only be trading at a single price. So one side of this position may be more profitable than the others, and normally if the trade does go against you, you can close it out with either a very small loss or maybe even a small profit without really harming your account. If we do keep it all the way to expiration, then all you have to do is take a look at the profit and loss graph to take a look at what your actual expiration profit potential is. So if you like the important thing here is to take a look at this profit picture and really like what you see. On this profit picture, you have a fairly wide break even, 141 on the downside, 155 on the upside. That's a 14-point spread between your high and low, and your current price is pretty close to the center. That's probably as close as we're going to get it. And so you've got a fairly wide margin of error here if the market goes up or if the market goes down. Like I said, though, it's very rare, and this is where the real secret of trading for monthly income comes in, and that is that you don't just put this position on, forget about it, let it go to expiration without taking a look at it at least 3, 4, 5 times a week, just for 10 or 15 minutes, and review the videos on portfolio management, especially to determine when you need to adjust these positions. Nobody's going to give you anything in the market. I mean, it's a given. Everybody is out for themselves, and that's the truth. They are not going to give you a profit on this position just because you decide to enter into the position. The truth is that the real profits come from adjustments when necessary. Remember, there's only two rules to the market. Rule number 1 is that prices will fluctuate. Rule number 2, as far as options go, is they will expire. And we take advantage of both of those absolute rules in the market because we have a wide price range that we're trying to profit from, and that takes, we are trading the first rule, which is prices will fluctuate. The second rule is options expire, and we're taking advantage of that because we are setting ourselves up for an expiration date in the future by using this green line as our profit target. And that's why these positions are really very powerful, because it takes advantage of the two biggest rules of the market. Now, if we were to enter this position, we've brought up our order confirmation dialog box. All we have to do is send it, and it goes off to the market, and we try to hopefully get our price. If we don't get our price, I show you in other videos when we actually enter into live trades exactly how to adjust your price in order to get filled on these positions. So take a look at those videos. Now, that is the double calendar. I'm going to show you how to enter into a position of the sale of an iron condor. And it's basically a very similar position. However, it's a little trickier to manage because of the fact that both of the options that the option that you're selling and the option that you're buying is in the exact same month. They're both in the front month. And the reason that we do not do this trade with less than 30 to 40 days to expiration is because normally you can't find trades that are priced right. In other words, if you want to go far out of the money on these trades, you're not going to be able to sell much of a premium on them. And that's the way we want a very large profit range on these trades. And let me show you exactly what I mean here. On this EEM, you can see that we only have 23 days left to expiration. So this is not the optimal time to enter into an iron condor, and let me show you why. If we wanted to have as wide as possible profit potential, we'd want to go at least $15 above the current strike price, which would be the 165 strike price on the EEM. and if we were to sell that option, we'd only receive about 10 cents for it. Because remember, you're selling it at the bid. Well, the bid is only 9 cents in this case. Maybe we could squeeze another penny out of this particular option and get 10 cents for it. And our protection, our protection is going to be much cheaper. It's only 5 cents. But that only leaves us with about 4 cents of profit potential. That's not very much. But let's take a look at it just for an example purposes. We'll take the 160s. We'll right-click on those. And now you can buy an iron condor and you can also sell an iron condor. If you buy an iron condor, that means you're buying a position in which time decay is working against you. So you always want to sell an iron condor. And all we have to do is come down to iron condor. We go to sell iron condor, and that brings up our dialog box at our call strike price of 160. If we're to sell the 160, we're going to buy the 165 for protection. And remember, we're running a business here. So what we want to do is we want to sell for more than we buy. And that's exactly what we're doing. We're selling the 160 calls for 38 cents. We're buying the 165 calls for 15 cents. The difference is our profit. Now on the put side, we want to go at least, in this case, we're going 10 points above the current price, so we want to go 10 points below the current price. The current price is 146.79, so we want to try to hit 135 if possible. Now on the downside, we actually have a little bit better premium. The 135 is selling for $1.16. So let's put in our prices here. We'll go to the 135 put. Now we want to sell for more than we buy. And that's what all good businesses do. They sell for more than they buy their product for, right? So we want to go down to the 130s, which is a lower price than our 135s. And the difference between what we buy and what we sell is our profit, just like any other business. So it looks like we can get a 81-cent credit on one contract. Now, how much is that actually going to give us in profit? Well, if we bring up our dialog box, it does calculate, because we are in the same month of buying. We're in the same month for both the sale and the purchase of our options. It can give us the maximum profit, maximum loss on this position. Our maximum profit is only $81 on one contract. Well, you can say, well, that's not very much money, but we only have to put up $400 to earn that $81. And that's close to that's a pretty good return on your investment. That's about 20% return on your investment in just a couple of weeks here before the expiration of these options. So that's not too bad. Let's take a look and see what happens if we do more than one option. Let's say we do, we go up to 5 options. Well, now we're earning $400 on $2,000 of money that we have to put up in margin. That's still, a 20% return on your investment in just a couple of weeks. That's not bad. Let's take a look exactly what this position would look like on our profit picture. We're going to right-click on this red area, and we're going to go to Analyze Duplicate Trade. Now we already have the other simulated trade in here. We're just going to X that out, close that out, and then we're going to take a look and see exactly what this looks like on our profit picture. Even with only 23 days to expiration, we have a fairly wide break-even on this position. Our break-even, and we can set these by going to Set Slices, and we're going to go to break-even on the date of our option expiration, which is May 17th. We can see that we have a fairly wide profit potential in break-even points at 134.24 on the downside and 160 on the upside. That's not too bad. The price can move close to 12 points on the downside and about 13 points on the upside. We're right in the center of that, and that's exactly how we make our money. As long as the price remains in this profit area, oops, I just white that out too much. As long as our price remains, our price is right now in the center of our iron condor. And that's where we like it to be, because the closer we get to expiration, then the closer we'll get to this green line, which is the maximum profit potential we will realize at the expiration of these options. The nice thing about iron condors is if you do take it all the way to expiration, you have no cost to close out these trades. You're not paying another commission to sell them out. The problem is, of course, is once this price, however, gets to one side, then we probably will have to do an adjustment. Most people will simply put on an iron condor like this, and they think, you know, if it moves against them, they're just going to close it out at either a small loss or a very small profit, probably at a small loss. And they say, well, iron condors don't work, you know, because they don't know the art of adjustment. The adjustments are everything. You don't just put these positions on and let them run against you without making some sort of adjustment. And that's where the real science of trading as a business comes in. Now, I have a very special guest with me today, a good friend of mine, Scott Foster, and he's been watching me as I was doing this video, and I'm going to open it up to questions for him and see if he has any questions on opening up these kinds of positions. Just put you on the spot.
Okay. Hello, everyone. This is Scott Foster. Anyway, it's a pleasure to be here, Dave. And, you know, I don't have any questions at this point. I'm still digesting this because this is the first time that I've actually sat and watched this. But I am very intrigued by this. And, in fact, you're encouraging me all the more because I've always wanted to learn how to make money in stock trading and options, as I've learned here. And so now I see it as a way I can actually do it. So, you know, this is just great. So I've been taking notes, and so at this point I don't have any particular questions for you, but I just want you to keep going because I'm enjoying this.
Do you think it was clear enough the way I presented this to show you how to enter these positions?
Yes. You know, I think you really simplify it when you say that there's, you know, two rules, you know, and that is one, that prices will fluctuate, and number two, that options will expire. So I mean, it doesn't seem to be any, you know, that's probably the most simplest way I've ever heard it put. You know, I mean, because at first glance, when you look at all of this with the software, I mean, it looks really confusing, but you're just really simplifying, you know, something that it looks very confusing. So this is awesome stuff, Dave.
That's great. I'm glad it's really clear because I want to make sure, and Scott really has no stock or trading experience. I mean, he was very interested in stocks several years ago, right? Yes. And but he doesn't have any experience trading stocks or options at the moment. And so for him to say that this is fairly clear, that's really, really encouraging to me because I want to make sure that everybody is very clear on how we set up these positions. And also the fact that we are taking advantage of the two most important and inviolate rules of the market. Prices will fluctuate and options expire. So we're taking advantage of both of those really and most important rules. When we set up these positions, now remember, if I go back to our Analyze tab here for a second, I'm going to take a look at, I'm going to delete our simulated trades, and I'm only going to take a look at our portfolio here. We are, you know, we want to set up a balanced portfolio. In other words, we're going to do some double calendars and we're going to do some iron condors. And this gives us a very, very nice profit picture here for our positions. We want to make sure that we are have a nice high profit picture or profit tent here, and that we're always kind of close to the center of the price movement, because we want to take advantage of the fluctuation in the price, and we also want to take advantage of the expiration of these options. So let me just show you an example of what happens. And with the TOS platform, you can actually go up to this thing called DayStep, and what it'll show you is what the profit potential of this position is over a number of days in the future. And this is pretty interesting. Right now, our current profit position looks like we have about, let's see, I'm going to set these slices back here. We have a small loss for the day, but remember, we just started this position. Now, if we take a look at our center price here, and take a look at this green line that seems to be flashing incessantly and annoyingly, but you can take a look down here on the left-hand corner. The green line is a date in the future, and that happens to be April 30th, which is just about 7 days away. In 7 days, if price movement does not dramatically go one way or the other, and we stay in a relatively narrow range here in the market, we will have moved from a loss of about $50 to a profit of $217. If we project out further, we go up to this blue line. If price, again, prices always fluctuate. That's the rule of the market. But however, if we keep our profit potential of this position under the current price, we will have a profit potential on May 7th, which is another week out, of $591. So as you can see, when I said that this white line will eventually move up towards our expiration position, because this is what it'll look like at expiration, it really does, over time, week by week, continue to move up until we get in a really nice, profitable position here. So this is week 1, this is week 2, this is week 3, and that's the kind of profit potential you can expect to have. As I've mentioned many times, it's very important to monitor at least your position on a daily basis. And it doesn't take a lot of monitoring. We've done videos on monitoring and reviewing your positions. It only takes about 10 or 15 minutes a day, and then you can go out and do whatever you want. Generally you can, if you got a day job, go to, you're talking about 10 minutes of just reviewing your positions. This is something that you can monitor either from work or on your lunch hour. And also, if you're, if you're an entrepreneur, or if you have a position where you can monitor these on a regular basis, it's only going to take you 10 or 15 minutes, and that's all you really need in order to run this business. And the profit potential is absolutely awesome. So I can't think of a better way to trade than this, because when you simply buy a call or you simply buy a put, you're really putting yourself into a position where you have the potential of losing your entire investment. If you're not correct in both direction of the underlying stock that you want to see, if you're buying a call and you want the stock to go up, you got to be right on direction, but you also have to be right in your timing, because if the stock does not move within a few days after you buying your option, you can see how much those options will actually decline in value the closer you get to expiration. So that's how we build our portfolio. We use two primary ways of building it. We use double calendars, and we use the sale of iron condors. And you can also, as you get more experience, you can add additional strategies to your positions. You can use regular double diagonals, which have a little bit more margin requirement, and they're a little bit trickier to adjust. But that's why I suggest for those, for you guys just starting out and building really profitable positions, is using the double calendars. The margin requirements are very, very low. If we go back to our trade tab here just for a second, on the sale of this iron condor, even though we're doing 5 contracts, the margin requirement is about $2,000. If we were to do the double calendar, at these positions. And we'll go back to these here. Whoops, I selected the wrong strikes. This is the original double calendar that we had selected. Let's see. Let's go up to, normally when you're starting out, you want to do between 1 and 3 contracts. The margin requirement is only $1,700. For the profit potential, as we said, well, with three contracts, the profit potential on this is $1,000, and you're only putting up a $1,700 in margin requirements. So you're getting close to 30, 40, 60% return on your investment in just a few weeks. And boy, I'll tell you, if you've been to the bank lately, you know that interest rates are pretty low right now. You're lucky if you get 2.5% a year on your money market fund. So even if you only did one contract, in this, your margin requirement's only $573, and you have a profit potential of close to $300. That's a huge return on your investment in just a few weeks. So that's it for portfolio building. The two main trading vehicles that we use are double calendars because of the margin requirements are so low, and they have a good wide profit potential for us. And we also use the sale of iron condors. They also give us a very, very good profit potential in a very short period of time. The key, of course, again, is to adjust those positions when necessary. And there is a timing involved in adjusting these positions because you don't want to wait too long. Let's just talk about that just for a second. Once your price begins to approach your break-evens on either side of these trades, you want to get into a position where you want to adjust them. And if you take a look at the adjustment videos, you'll see exactly how we do that. In the case of our IWM position, this is one way that we actually adjusted. This position. I'm going to show you exactly what we did here. On this IWM position, we had a double calendar on. The price ran against us to the upside to the point where it was very close to our break-even point. So what we did in order to compensate for that, whoops, I'm going to try to spread this out a little bit. There we go. What we did for that, it ran very, very close to our break-even point. Well, in most cases, most option traders would panic at that point and say, oh, the trade's not going to work out because if it starts going beyond my break-even point, I'm going to be in a losing territory. I'm going to start losing a lot of money. Well, what we did instead was we put on another double calendar on top of the double calendar that we already did, which allowed us to extend our break-even points and put us back into a profitable position. Our original double calendar was centered right in the center, but our prices ran up against us, and then to adjust, all we had to do was put on another double calendar on top of that, and it put us back into a very profitable position. It was a very easy adjustment to make, and once you understand how to do adjustments, there's no reason really for you to lose money. Now there are extreme situations in the market in which price is just out of control. You're talking about October of 1987, for example, and the market drops 500 points, which is a huge percentage move at that time. In those kind of situations, you're probably better off just getting out of your position altogether. You just wanna exit. But we've had one instance of that in 20 years, and logic would tell us and probabilities would tell us that those are maybe once in a half century moves that could affect our positions. But because we put positions on calls and puts at the same time, generally what's going to happen is, we're going to get hurt on one side of our trade if we do have a dramatic move like that, but on the other end we're going to make money. So those are the kind of protection, the kind of hedging that we want to do in these positions in order to remain profitable. So even if we do get very dramatic moves in the market, we're going to be prepared because we know what to do. And that's why I always say trade with confidence. Any last remarks there?
Well, you just summed it all up. I think Dave is trading with confidence, and I can certainly see myself, doing that here in a very short period of time. I'm very excited about this, Dave, and I thank you for the opportunity to come and sit with you here and actually watch you do this live. So I'm really excited about this, and I think anybody else watching this is feeling the same way.
That's great. The thing is that we can put these trades on, but you know what? When it gets down to the point where you're actually starting to make these trades, and you need some assistance, that's why we put our membership site together, so that you can see the positions that I put on a daily basis, and then you can go back and take a look at, because I record the videos in the morning, I put them on the website right away of the review of that day. You can, if necessary, if you need additional help, you can see exactly what adjustments I've made so that you can make them in your portfolio at the same time. I'm not making specific recommendations for your investments. It's for educational purposes really only, because I'm not an investment advisor. However, you can see what I'm doing and then take that into consideration of your own investment objectives and then go from there. But it does help you to see exactly what I'm doing, and then whether it makes sense for your position or not to make those same type of adjustments, but also to see the type of adjustments that you can make in your position so that you remain profitable, or if it gets to the point where you need to get out and cut your losses short. But our objective with adjustments, of course, is always to remain as profitable as possible. And so that's why we set up our membership site, just so that you can see exactly what potential there is for adjustments to these trades, and also what kind of trades and new information might be available in the future. Because as you grow in experience with these trades, you're going to see that there are other trades that you might want to take that actually increase the profit potential of your overall portfolio. And for educational purposes, you can't beat it. Our membership site is always on the cutting edge of these types of trades, and we're going to teach you everything that we learn as we go along.
Well, thank you very much, Dave. This is good stuff.
Well, thanks for being with me, Scott. Yeah, it was really a pleasure to have you here, and I'm glad I could explain how to build your portfolio, because it's a really critical component of this system. All right, guys, that's it for today. Trade with confidence.